Imagine standing in a room where every surface is covered with mirrors, each one reflecting a slightly different version of reality. That's what reading financial markets feels like to most people. They see prices moving, charts fluctuating, headlines screaming, but they can't tell which reflection is real and which is distortion. They're surrounded by information, drowning in data, yet somehow more blind than if they had access to nothing at all. The noise overwhelms the signal, the urgent obscures the important, and by the time clarity arrives, the opportunity has already passed. But here's what the professionals know, what the institutions understand, what separates those who capitalize on major moves from those who watch them happen to others. Markets telegraph their intentions before they move. They send signals, subtle but unmistakable, through patterns that most people never learn to recognize. These signals don't appear on the front page of financial websites. They don't trend on social media. They exist in the deeper architecture of how capital flows, how yields behave, how correlations shift. And right now, in the metals market, those signals are starting to align in ways that historically precede significant rallies. What I'm about to share with you isn't speculation. It isn't hope disguised as analysis. It's a framework for reading the market's actual mechanics, for understanding how institutional money moves, how yield curves shape opportunity, how correlations reveal hidden drivers. This is the kind of analysis that helps you see through the mirrors, past the distortions, directly into the structure of what's actually happening. And once you see it, once you understand how to read these signals, you'll never look at markets the same way again. If this approach to understanding markets resonates with you, if you want access to analysis that goes beyond surface level commentary and into the actual mechanics of how major moves develop, then subscribe now and join us for the next reports and alerts. Because what we're exploring today is just the beginning of a much deeper conversation about how to position yourself intelligently in an environment where most participants are flying blind. Let me start with something that sounds almost too simple to be profound, yet it's the foundation of everything else. Price is not the signal. Price is the outcome. By the time price moves enough for everyone to notice, the informed money has already positioned itself. The rally has already begun, even if it's not yet visible on the charts most people watch. This is why chasing price is a losing strategy. This is why waiting for confirmation means waiting too long. The real edge comes from reading what happens before price moves, from understanding the forces that precede the visible outcome. Those forces express themselves through flows. Capital doesn't sit still. Every day, billions of dollars move from one asset class to another, searching for the best risk-adjusted return, responding to changing conditions, repositioning based on new information, or shifting expectations. These flows create pressure. When capital flows into an asset class, it creates buying pressure that eventually pushes prices higher. When capital flows out, it creates selling pressure that eventually pushes prices lower. But here's the critical insight. Significant flows often begin long before price reflects them. There's a lag, sometimes weeks or even months, between when institutional money starts repositioning and when that repositioning becomes obvious in price action. This lag exists for several reasons. Large institutional players can't move all at once without moving the market against themselves. So they accumulate slowly, patiently, during periods when sentiment is still skeptical, when liquidity allows them to build positions without pushing prices higher prematurely. They use derivatives to gain exposure without immediately impacting spot markets. They work through private channels, over-the-counter transactions, dark pools where their activity doesn't immediately show up on public exchanges. But despite this stealth, they leave traces, And if you know where to look, you can detect those traces and understand that something is shifting beneath the surface. In the metals market specifically, there are several flow indicators worth monitoring. The first is futures positioning. The Commitments of Traders report, released weekly by the CFTC, shows how different categories of market participants are positioned. When you see commercial hedgers, the producers and industrial users who typically have the best information about physical supply and demand, reducing their short positions or even going long, that's a signal. When you see managed money, the large speculators beginning to accumulate long positions after a period of pessimism, that's another signal. These shifts don't guarantee immediate price moves, but they tell to you that the smart money is repositioning for something different than what the recent past delivered. The second flow indicator is activity in physically backed exchange-traded products. When ETFs that hold actual metal see consistent inflows, when investors are adding to these positions rather than redeeming them, it creates real demand for physical metal. That demand has to be satisfied by either existing inventory or new supply. And when inventory draws down or when new supply is constrained, prices respond. Right now, after a period of redemptions in certain metal ETFs, we're seeing that trend stabilize and in some cases reverse. This isn't front page news. It's happening quietly, but it's a signal that investor appetite is changing. The third flow indicator, and perhaps the most important for gold specifically, is central bank activity. Central banks are the ultimate long-term institutional investors. When they buy gold, they're not trading it, they're not trying to flip it for a quick profit. They're making strategic decisions about reserve diversification, about hedging against currency risk, about positioning for a world where confidence in fiat money might not be as absolute as it has been. And central banks globally have been net buyers of gold for years now, with that buying accelerating recently. This is not retail sentiment. This is not speculative positioning. This is strategic capital making long-term bets about the structure of the monetary system. When you combine these flow indicators and see them pointing in the same direction, when institutional positioning is building, when physical demand is firming, when central banks are accumulating, you're seeing the early stages of what could become a significant move. But flows alone don't tell the complete story. You also need to understand the environment in which those flows are occurring. And that's where yield curves become essential. The yield curve is one of the most powerful tools for understanding the macroeconomic environment and its implications for different asset classes. At its core, it's simply a snapshot of interest rates across different time horizons. Short-term rates on one end, long-term rates on the other. But the shape of that curve, the relationship between those rates, contains enormous information about what the market expects for growth, for inflation, for monetary policy, and for assets like gold and silver that don't generate cash flows, that don't pay dividends or interest. The yield curve directly determines their relative attractiveness. Here's why. When you hold gold or silver, you're giving up the opportunity to earn interest by holding bonds or depositing cash. That foregone interest is the opportunity cost of holding metals. When interest rates are high, that opportunity cost is significant. When rates are low, that opportunity cost shrinks. And when real interest rates, meaning nominal rates minus inflation, are negative, that opportunity cost disappears entirely. At that point, you're being paid in real terms to not hold cash or bonds. And that's precisely when metals become most attractive on a fundamental basis. The shape of the yield curve tells you not just what rates are today, but what the market expects them to be tomorrow. A steeply upward sloping curve, where long-term rates are much higher than short-term rates, typically signals expectations of future growth and potentially higher inflation. A flat curve where short and long rates are similar signals uncertainty or expectations of slowing growth. An inverted curve where short rates exceed long rates typically signals expectations of recession and future rate cuts. Each of these shapes has different implications for metals. What's happening right now is particularly interesting. After a period where central banks raised short-term rates aggressively to combat inflation, the curve became inverted in many major economies. That inversion signaled that the market expected those high rates to eventually slow growth enough to force rate cuts. And inverted curves have historically preceded recessions. But recently, we're starting to see that inversion ease. Short-term rates are beginning to come down, either through actual policy cuts or through market expectations that cuts are coming soon. Meanwhile, long-term rates have remained relatively elevated, held up by persistent inflation expectations and concerns about long-term fiscal sustainability. This shift from inversion toward a more normal or even steep curve is significant for metals. It signals that the period of extremely high opportunity costs is ending. It signals that real yields, which had turned positive during the tightening cycle, are likely to fall again. And falling real yields have historically been one of the most reliable indicators of better conditions for precious metals. This doesn't mean prices rise immediately. It means the environmental backdrop is shifting from hostile to favorable. And when the environment shifts, flows follow. But there's another dimension to yield curve analysis that's equally important. The curve doesn't exist in isolation. It interacts with currency markets, with credit markets, with equity valuations. When central banks cut rates, or when the market expects cuts, currencies typically weaken. A weaker dollar specifically makes dollar-denominated commodities like gold and silver more affordable for international buyers, which tends to increase demand. At the same time, easier monetary policy often supports risk assets initially, creating a tailwind for equities and credit. But if that easing is happening because growth is actually weakening, eventually the risk-off impulse takes over, and metals benefit from safe haven flows. So when you're trying to read early signals, you need to watch how the yield curve is evolving and what that evolution means for the broader macro environment. Is the curve steepening because growth expectations are improving or because rate cut expectations are increasing? Are real yields falling because nominal rates are dropping faster than inflation expectations? How is the currency responding to these yield curve changes? These are the questions that help you interpret whether the yield curve shift is likely to be supportive for metals or not. Right now, the answers to those questions are increasingly favorable. Real yields are declining. Rate cut expectations are building. Currency pressures are mounting as fiscal deficits remain large and debt servicing costs strain budgets. The yield curve is shifting in ways that reduce the opportunity cost of holding non-yielding assets. This doesn't guarantee a rally starting tomorrow, but it creates the conditions in which rallies become much more probable. It's like dry wood accumulating in a forest. It doesn't spontaneously combust, but once a spark appears, the fire spreads quickly. Now let's talk about correlations, because this is where the picture gains even more resolution. Correlation measures how two variables move in relationship to each other. In financial markets, understanding correlations helps you understand what's driving price action, what role different assets are playing in portfolios, and when those roles might be shifting. For precious metals, correlations with currencies, with real yields, with equity markets, with credit spreads, all of these relationships contain information about the underlying dynamics at work. Gold, historically, has exhibited a strong negative correlation with the US dollar and with real interest rates. When the dollar weakens, gold typically strengthens. When real yields fall, gold typically rises. These relationships make intuitive sense. Gold is priced in dollars, so dollar weakness makes it cheaper for foreign buyers and more expensive in dollar terms. Gold doesn't generate cash flow. So when the real return on bonds falls, gold becomes relatively more attractive. These correlations aren't perfect, and they can break down during periods when other factors dominate, but over time they reassert themselves. Silver's correlation structure is more complex because it has both monetary and industrial characteristics. During periods when monetary factors dominate, when inflation fears or currency concerns drive investment demand, silver tends to move closely with gold, often with even more volatility due to its smaller market size. During periods when industrial factors dominate, when economic growth is strong and manufacturing demand is robust, silver can correlate more closely with industrial metals like copper. This dual nature makes silver's correlation patterns particularly informative. When silver's correlation with gold strengthens relative to its correlation with industrial metals, it's often signaling that monetary concerns are becoming more important than growth dynamics. What's crucial for detecting early rally signals is not just knowing these average correlations, but watching for changes in correlation patterns. When correlations shift, it often signals that the market is transitioning from one regime to another, that different factors are starting to drive price action, that the role of metals in portfolios is evolving. And those transitions, those regime changes, are often where the biggest moves originate. Right now, there are several correlation shifts worth noting. First, gold's correlation with short-term dollar fluctuations has weakened somewhat. Gold is not responding to every tick in the dollar index the way it did in previous periods. This suggests that other factors beyond simple currency dynamics are gaining importance in gold's price determination. Those factors might include safe haven demand, central bank buying, or positioning ahead of expected monetary policy changes. Whatever the specific driver, the weakening of this correlation tells you that gold is not just a dollar trade anymore. It's something more. Second, silver's correlation with equity markets, which was quite pronounced during the risk-on periods of recent years, has begun to diminish. When stocks rallied, silver rallied. When stocks sold off, silver sold off. That behavior made silver look like just another risk asset, another way to express optimism about growth. But recently, that correlation has loosened. Silver is holding up better during equity weakness and not necessarily surging during equity strength. This shift suggests that silver is transitioning from being perceived purely as an industrial demand story to being seen once again as a monetary asset, as a hedge against currency debasement and financial instability. Third, the correlation between metals and credit spreads has started to reassert itself. Credit spreads measure the difference in yield between corporate bonds and government bonds. When spreads widen, it means the market is demanding more compensation for credit risk, which typically signals economic stress or financial fragility. Metals, especially gold, tend to perform well when credit spreads widen because they are ultimate safe haven assets. After a period where this correlation was muted, we're seeing it strengthen again. When spreads tick wider, metals are firming. When spreads tighten, metals aren't weakening as much as they used to. This asymmetry is bullish because it suggests metals are acting as insurance against downside risk while not penalizing you as much when those risks temporarily recede. These correlation shifts don't happen in a vacuum. They reflect changing perceptions about what matters in markets, about what risks are relevant, about what role different assets should play. And when you see multiple correlations shifting simultaneously, when the relationship between metals and other asset classes is evolving across several dimensions, that's a strong signal that something fundamental is changing in how markets are pricing risk and reward. Let me give you a practical way to synthesize all of this, because the goal isn't to drown you in data, but to give you a framework for making sense of it. Think of flows, yield curves, and correlations as three different lenses through which you're viewing the same underlying reality. Flows tell you what informed money is doing. Yield curves tell you what environment that money is operating in. Correlations tell you what relationships are driving behavior. When all three lenses show you consistent pictures, when they're all pointing in the same direction, that's when conviction should build. Here's what alignment looks like in practice. Flows are showing institutional accumulation. Futures positioning is building. ETF redemptions have stopped or reversed. Central banks are buying. That's the first lens. The yield curve is shifting in ways that reduce opportunity costs. Real yields are falling. Rate cut expectations are rising. The curve is steepening. That's the second lens. Correlations are changing in ways that suggest metals are transitioning towards safe haven roles. The dollar correlation is weakening. The equity correlation is loosening. The credit spread correlation is strengthening. That's the third lens. When you see that kind of alignment, you're not guessing. You're reading the market's own signals. You're seeing what institutional money sees, what the bond market is pricing, what correlation patterns are revealing. And that alignment doesn't guarantee that prices will explode tomorrow, but it dramatically increases the probability that a significant move is building, that the next major leg higher is closer than most people think. Remember, this content is educational and not financial advice. Its purpose is to help you think more clearly about your decisions. But the framework we're discussing, this focus on flows, on yield curves, on correlations, this is not retail sentiment analysis. This is not technical pattern recognition. This is institutional grade thinking, the kind of analysis that large pools of capital use to time their positioning. And the reason they use it is because it works. Not perfectly, not every time, but over cycles, over multiple instances, this kind of analysis gives you an edge. One more dimension worth exploring is liquidity, because liquidity is the medium through which all of these signals translate into price action. Liquidity refers to how easily you can buy or sell an asset without moving its price significantly. In liquid markets, large orders can be executed with minimal price impact. In illiquid markets, even modest orders can cause significant price swings. Metals markets, particularly silver, are not as liquid as major equity indices or currency pairs. This means that when flows do shift, when institutional money does begin repositioning, the price impact can be substantial, but liquidity itself is not constant. It varies with market conditions, with volatility, with the willingness of market makers to provide depth. During periods of calm, when volatility is low and confidence is high, liquidity tends to be abundant. Bid-ask spreads are tight, and markets can absorb large orders without much disruption. But during periods of stress, when volatility spikes and uncertainty rises, liquidity can evaporate quickly. Market makers widen their spreads, pull back their quotes, and suddenly the same order that would have been routine in calm conditions creates a significant price move. This liquidity dynamic is crucial for understanding how early signals can suddenly translate into dramatic price action. The flows might be building slowly, institutional money might be accumulating gradually, the yield curve might be shifting incrementally, but if a liquidity event occurs, if something happens that causes market depth to disappear, those accumulated positions and those environmental shifts can suddenly express themselves in violent price moves. This is why metals, rallies, often feel like they come out of nowhere, why they seem to accelerate beyond what fundamentals alone would justify. It's not just the fundamentals changing, it's the fundamentals changing in an environment where liquidity is thin, where the market can't absorb even moderate flows without significant price adjustments. Right now, we're in an interesting liquidity environment. On one hand, central banks have been withdrawing liquidity through quantitative tightening, reducing the overall amount of money in the financial system. On the other hand, we're approaching a point where that tightening may pause or reverse as growth concerns mount and debt servicing pressures intensify. If and when central banks pivot back toward easing, when liquidity begins flowing back into the system, that's typically when assets that had been constrained by tight liquidity conditions begin to outperform. And metals, given their relatively small market size compared to equities or bonds, tend to be among the biggest beneficiaries of liquidity expansion. So as you're watching flows, as you're monitoring yield curves, as you're tracking correlations, keep one eye on liquidity conditions as well. Are central banks expanding or contracting their balance sheets? Are credit conditions easing or tightening? Is volatility rising or falling? These liquidity indicators will tell you how quickly and how dramatically the other signals might translate into actual price moves. Let me bring this all together with a real-world example of how these signals worked in the past. Think back to late 2018 and early 2019. The Federal Reserve had been tightening policy aggressively. Short-term rates were rising, the yield curve was flattening, and eventually inverted. Equity markets sold off sharply in the fourth quarter of 2018. Credit spreads widened, and during this period, gold was going nowhere. It was stuck in a range, seemingly unable to break out despite all the uncertainty. But if you were watching flows, you would have noticed that central banks were buying gold aggressively. You would have seen that ETF redemptions, which had been persistent, were starting to slow. You would have noticed that futures positioning, which had been heavily short, was beginning to normalize. The flows were shifting even though price wasn't reflecting it yet. If you were watching the yield curve, you would have seen that the inversion was signaling future rate cuts. You would have recognized that real yields, while still positive, had likely peaked and were positioned to fall as the Fed eventually capitulated. The curve was telling you that the high opportunity cost environment was temporary. If you were watching correlations, you would have noticed that gold's correlation with equity markets was weakening. It was starting to hold up better during equity sell-offs. Its safe haven characteristics were reasserting themselves. The correlation shifts were telling you that gold's role in portfolios was changing. And then in early 2019, the Fed pivoted. They signaled that rate hikes were over and that cuts might be coming. Liquidity concerns eased, and gold, which had been stuck around $1,200 per ounce, began a rally that took it above 1,500 within months and eventually to new all-time highs above 2,000. That rally didn't start when the Fed pivoted. It started when the signals aligned, when flows showed accumulation, when the yield curve showed the high opportunity cost period was ending, when correlation showed that gold's role was changing. The Fed pivot was just the catalyst that made all those accumulated pressures visible in price. We're approaching a similar inflection point now. The signals aren't identical because no two cycles are exactly the same, but the pattern is familiar. Flows are shifting. The yield curve is evolving in favorable ways. Correlations are changing to reflect metals' safe haven characteristics and liquidity conditions, while still somewhat tight, are positioned to ease as central banks face the reality that high rates are unsustainable. This doesn't mean you should blindly buy metals and expect immediate gratification. It means you should be paying attention, you should be building conviction, you should be preparing to position yourself for a move that's more probable than most people recognize. Because by the time that move becomes obvious to everyone, By the time it's being discussed on financial television and trending on social media, the majority of the move will have already happened. The early movers, the ones who read the signals correctly, will have already positioned themselves. The late comers will be chasing, buying at higher prices, taking more risk for less reward. That's the nature of markets. They reward those who can see before others see, who can interpret signals before they become obvious, who can act when doing so requires conviction rather than waiting until action requires no conviction at all, because everyone else is already doing it. The tools we've discussed today, the focus on flows, on yield curves, on correlations, these are the tools that allow you to be early rather than late, to position with conviction rather than chase with fear. The metals market is not shouting at you right now. It's whispering. But if you listen carefully, if you watch the flows, if you read the yield curve, if you track the correlations, you can hear what it's saying. It's saying that conditions are shifting, that the hostile environment of recent years is transitioning towards something more favorable, that institutional money is beginning to reposition, that the next significant move may be closer than the current price action suggests. This is your opportunity to be on the right side of that move, to position before it becomes obvious, to act on signals rather than react to outcomes. The choice, as always, is yours. But the signals are there, waiting to be read by those who know how to look,